The interesting setup for gold was the amazing performance that we saw in the face of the most aggressive monetary tightening in 40 years in response to the highest rate of inflation in 40. Now, on one hand, you can say, well, if gold's this great inflation hedge, well, yeah, that's why it should have traded well, which is in part true. But if the major headwinds historically for gold has been high real rates and a strong currency, particularly the dollar, then gold should not trade so well. And it did. And I think a big game-changing event was the decision by the EU, mostly the EU, to freeze half of Russia's central bank reserve after they invaded Ukraine. So if you're in China and you own more than $1 trillion at the time of US treasuries, and you see just by government fiat what was done, you're saying, oh shit, do I want to own this many treasuries? And are there other places where I can store my reserves? And it wasn't just the decision that was triggered in China. It was in Saudi Arabia. It's anywhere that deals with a lot of dollars that is parked in the US, whether that's at a bank or that's within US treasuries. So that's when we saw a real acceleration of central bank buying. Then you also throw in that the petrodollar is not as petrodollar as it once was. It's maybe petrodollar / gold in a way, because we've seen, of course, that countries are transacting more in their own currencies and less with the dollar. And as we know, after the early 70s, any transaction that took place in oil, particularly with anybody wanting to deal with the Saudis, had to do it in dollars, and that is no longer the case. So there's extra money that gets produced in that doesn't have to be parked in dollars, and gold is a store of value for that money. And we've seen that big time over the last couple of years. And then all of a sudden, gold just needed a little tailwind, and that was possibly the end of the Fed rate increases, even though we'll wait to see when they cut. But we're also seeing, while maybe the Fed doesn't cut, the ECB's ready to cut, Swiss National Bank already cut, Bank of Canada is looking to cut. So we've seen peak short-term rates, and I emphasize short-term rates because there's still a lot of risk that we see higher long-term rates. And one last thing, and I'll throw it back to you, is of course there's worries about U.S. debts and deficits getting out of control, and why not own some gold? I think the 5.5% Fed funds rate is a main reason why not only have they lessened their demand for physical, in actual coin or bar form, but we've also seen that within all the ETFs, where there's just been a constant drawdown in ETF holdings of gold since early 2022, when the Fed started aggressively raising interest rates. I think the average person doesn't necessarily make also the distinction between nominal rates and real rates, and also understanding that gold can still trade well, even though it doesn't pay you a yield. And that the performance of gold, without paying you that yield, I think really says a lot about the demand. Unfortunately for retail, we're beginning to see a lot. I mean, you look at Costco that's selling since September of last year, selling gold bars. Right. In a way that introduced the average person who wasn't necessarily thinking about owning physical gold. They were more focused on, buying paper towels and tissues and a lot of boxes of cereal and ketchup when they went to Costco. That, wow, hey, I guess a gold bar is real, and I can actually see it and actually feel it and actually can take it home with me, other than, as opposed to other things that people only see on their computer. Silver is outside of natural gas. There aren't too many more volatile commodities than the two of them. And when it goes, it goes. And when it's dead meat, it's dead meat. And we know silver has just been in a trading range for a decade plus. But silver is just so unique, and it's so unique because it wears so many different hats, plays so many different roles. It plays a role if you're building out a solar farm where you need the producer of those panels needs silver. It plays a role in building an iPhone and other electronic products. It plays a role in an EV battery. It plays a role if you sit down to eat dinner and you happen to have silver tableware. It plays a role if you're interested in jewelry, and it plays a role as a monetary metal similar to gold. So that's why I believe it's so unique. And it is so badly lagged, this rise in gold, and it's badly lagged a lot of other industrial metals as well, particularly copper. And I see a lot of upside here. I mean, silver is almost 50% below, just looking at it, the future, front month future of 28. It reached 50-ish, both in 1980 and 2011. And here you have gold well above those previous peaks and silver that is still substantially below. And I know sometimes silver one day trades like an industrial metal similar to copper, another day it'll trade like a monetary metal similar to gold. But I think it's one of the cheap assets out there. And one of the, the sort of basic amateurish way of valuing silver is just the silver gold ratio, even though it's just a back of the envelope more than anything else. But you do the average of 60 times going back the past 50 years, and you get a silver price well into the 30s. So it's pretty intriguing to me, as well as gold. You look back just to even 2021, when money was falling from the sky and all you need was a PowerPoint presentation and a pulse, and if you said something sexy in tech, you were going to get an investment. If you came with a PowerPoint presentation on this new gold mine in early 2021, people were going to laugh at you. And even well before that, I mean, you talk about going back to when gold peaked out in 2011 and then really sold off in 2013. All the investor focus, all the investment dollars didn't go into the mining business. And also that was around the time in 2014 when oil sold off hard and investors started to say, hey, we're not just going to invest in companies that are just drilling for drilling's sake. We want cash flow, we want discipline, and so on. A huge amount of investment dollars went elsewhere, and we know where they went. We saw where it went, but it didn't go into the mining business. So we've had years of, and then you throw in ESG, and then you throw in, every politician that beats you up for being an executive at a mining business. Putting aside that they desperately need your product, particularly the same politicians that are trying to create this new energy world, well, they need you even more. So now it's sort of payback, it's catch-up time, where we need the investment dollars, but it's very difficult not only to put that to work in a friendly jurisdiction, but the timeline of developing a project has just gotten so long that it dissuades a lot of people from even wanting to do that. And they say, do I really want to go through all these headaches of going down the road of developing a mine and dealing with the jurisdiction, uncertain about what, and especially if it's in a foreign one outside of the US, Canada, Australia, for example, of what is the tax rate change going to be? I mean, just look at the experience in Panama with First Quantum and what they went through and literally just losing your mind, having it confiscated. Now, maybe it works out, maybe there's some reversal of that policy, but you got to have, a set of guts if you want to develop a mine right now that you may not see the fruits of for 10 to 15 years. Stretching back, when you look at the first spurt to that 5% level in the 10-year, it really started at around July 27th, 28th, when the Bank of Japan decided, because I'm going to tie this to the yen and JGBs also, when the Bank of Japan decided to again widen yield curve control from 50 basis points to 100, and JGB yields rose, and to me that was the trigger for the 10-year yield to go from about 380-ish up to 5. And then after it got to 5, the BOJ actually backed off from getting out of negative interest rate policy. The Fed started talking about possibly cutting interest rates in 2024, and then we started to price in as many as 6 rate cuts into the Fed funds futures market, and that's why you saw the back down in the 10-year yield back to around 4ish again. But now we're right back up again because maybe the Fed's not going to be cutting at all this year with sticky inflation that is complicating their plan. And plus you have the CRB index at the highest level since August 2022 that further complicates what the Fed wants to do. And also the conversation that was alive and well in the fall of last year about rising debts and deficits that sort of went away when yields fell. Well, those debts and deficits only get worse every single day. And for the first time in our lifetimes, I do believe they matter. And, getting back to the Japanese, and sorry to sound hyperbolic here, but when we had $18 trillion of negative yielding bonds around the world, that was the biggest bubble in the history of all bubbles in terms of dollars. And we're now seeing the unwind of that. And the higher rates that we've seen in Japan, where the 40-year JGB yield, and the reason why I bring up the 40-year is because it's furthest out from BOJ manipulation and basically zero short-term interest rates. So it's the most market-driven area of that yield curve. That yields at the highest level since 2011. And where JGB yields go helps to determine where German Bund yields go, helps to determine where U.S. Treasury yields go. And we're all in this together. And with respect to the yen, Japan is the largest foreign holder of U.S. Treasuries. They own less than they did at the peak, but they're still the largest holder. So where the yen goes directly influences their appetite for U.S. Treasury. Japan imports about 95% of their energy needs. Maybe it's a little less based on the last data, because they're beginning to turn on nuclear plants, but they basically import a majority. And when the yen gets weaker, that gets more expensive for them. Well, what helps to finance those energy needs is they sell U.S. Treasuries and they bring that money back. So I think that interrelationship between the rise in oil prices, the weakness in the yen, the rise in long-term interest rates are very intertwined. Not the only reason why we're seeing these moves, because we also have interest rate differentials between the yen and the dollar course, and oil prices are still moving with geopolitical reasons, and so. But it is a factor that flows through. So when people wonder, like, who cares about the yen? Well, you should care very much about the yen because it flows into U.S. markets, U.S. interest rates very directly.